Welcome to the Bitcoin Macro War Room, where we jack into the market mainframe and derug the narrative. Plug into the pipes, M2, DXY, inflation, momentum, fresh prints, CPI, ISM, payrolls, rates, truth by facts, not vibes. Tweets and news rundown, meme to policy, curated, timestamped, tradable.
Welcome, you've got mail.
Copium not included. Roll the tape, let's invest like it's 1999, but with better charts.
Let's go. Welcome back. It's another Friday, another Bitcoin Macro War Room for you on deck. Crazy week in Bitcoin, up about almost 11% this week. But I'm here to taper some expectations. Super bullish still, of course. I've been saying that for weeks now. All the cycle top callers will be in shambles as we go into 2026. But let's dive into some of the data this week. We'll take a look at the charts. I have some spicy tweets to share at the end, so stick around for that one. We're going to break everything down, and we're going to start it, as we usually do, with the chart. So let me move my camera here to the proper position. And as you can see sort of right away, the first thing that I wanted to call out was global liquidity has broken up off the neckline. As I kind of mentioned last week, this was what I was expecting. So again, still bullish momentum in M2. And it would be absolutely insane if we did end up closing this gap. I mean, that would be absolutely ridiculous. First of all, that would put Bitcoin at around 180,000, something like that. Could that happen? Potentially, of course, but probably more for next year than for this year. I think we do sort of close this gap, maybe somewhere here, but we'll find out. We'll get into some of the data. We'll take a look at my system, which is probably the most important part of this video in a little bit. But again, a great week so far. Could the bottom be in? Possibly. I mean, if we hold this and break through to new all-time highs, it becomes ever more likely in terms of probabilities that this here was the bottom and we're going to be going higher. In terms of my regime tracker, the indicator down here, still kind of hugging this lower trend line. So I'm looking for that to kind of start expanding upwards, and that'll probably happen as the ISM numbers come out a little bit more positive, which is what we're going to look at next. We're going to look at the data. So let's take a crack at it here. And honestly, not too crazy in terms of data this week. I think the most important things were the JOLTS, job openings, the PMIs, the prices, because for JOLTS, job openings, they came in a little bit above, which is fine. They didn't really miss or beat too high. It measures how many job openings exist. So it's a proxy basically for labor market strength. And that means that labor demand is still elevated, which is not great in terms of the Fed's eyes, but all the other prints were liquidity positive, rate cut positive, which is the most important thing. So for the CB consumer confidence, this is actually one of the more important ones I thought this week, which I didn't just call out, but I should have. This reflects household sentiment on jobs and income, and this came in lower than the forecast, not by a lot, but the drop shows that households are turning cautious, and that gives the Fed more room to ease. So that's bullish. ISM manufacturing PMI did beat by 0.1, so not a lot there, but it's trending in the right direction. So you can see, again, we've been under 50 for so long, but it seems to hopefully be turning up here. And once this breaks above 50 and starts into expansion, that's when the majority of the gains will be coming, in my opinion. So that's a good positive development. I think for the manufacturing prices, this also missed by a little bit. And this is important because this tracks pressures in manufacturing, price pressures specifically. So it's a inflation metric on input costs. The cooling here, even though it's not by much, just means that inflationary pressure is easing, which gives the Fed room to cut. And we'll take a look at the actual odds next, because these have shifted dramatically since last week. I think we were at 70 or 80% for a cut, and now we are basically locked in terms of the Fed cutting another 25 basis points at the next meeting here at the end of the month in October. And what was more interesting to me was December is now an 86% chance of another cut, another 25 basis point cut. So that'll be 3 cuts this year. And then if we look at January, there's a 40% chance that there might be yet another cut from December. So could be potentially 4 cuts by the time we get to February of next year. And if we take a look at the probabilities here, these again have shifted pretty dramatically to the left. So for June of next year, we're looking at potentially a 3% federal interest rate. And that's pretty much it for the Fedwatch tool. Again, this is super bullish, and I think the numbers sort of reflect that. So let's take a look at the system, what you're probably here for. And I updated this right before we started, and this flipped pretty much super risk on. I think last week we were at 78% or 77, something like that. And I did mention that when this drops to the 70s or the 60s in a bull market, which I believe we are in, that is an amazing place to sort of add to your positions, do some DCAing if you have dry powder and extra cash. So we are currently at 93% risk on. All of the institutional research I use has not shifted. It is still bullish to extremely bullish, which is great to see. The 2 main things or 3 main things that flipped this week to bullish are the liquidity regime tracker. Actually, this is reverse. This should be 0.5 and this should be 1. That's not going to change the scores, but global liquidity flipped to bullish because it's accelerating now. And everything else here, STH flipped to bullish, and the bull bear market cycle indicator flipped to bullish because it is trending higher. And we'll take a look at those now. So for the DXY, again, this has been bullish. I think this will continue to be bullish for quite a while. You can kind of see how it's performed, but basically dollar down means risk assets up. So the dollar has been sort of down here since July and since the drop in April. So nothing really changed there. MVRV ratio, Z-score. Again, this is about to flip bullish. So this will put this last score from bearish into bullish probably tomorrow, if I had to guess, just because of how close the MAs are to crossing. So again, this has done really well this cycle as well. And then for STH, I mentioned this last week, but generally when we have went under the short-term holder realized price, that has been an amazing place to add to your positions, which is something I did as well recently. And you can see that we are now bullish again. We are above the STH realized price. So everything's good there. The bull bear market indicator, again, this has been bullish the entire cycle. So nothing's really changed. And you can see we are just starting to sort of re-accelerate here, which is why the score changed to 1. So with that all out of the way, I did want to take a look at the old dashboard that we used to look at and just see if there's anything interesting that we can take a look at. And the Bitcoin heat macro phase has bounced and is trending up higher now, which is good, but you can see it's still really low in terms of where it could go. So I think there's still potentially more room to run, and we'll kind of see how that works out. For the Sharpe ratio, I don't know what is going on with this. Let's just do year to date. But yeah, the Sharpe ratio has turned up, which is positive. Newpol, again, nothing's changed. We're still in yellow and turned up. IFP, again, is bearish. This has been the case since I started this freaking show. It's been bearish. This used to be in the system, and we've taken it out because I don't think this performance is good enough. If you were bearish this entire time, you would have missed out on amazing gains. You could have gotten in at like 85K. And yeah, this thing has just been bleeding the entire time. So we'll keep an eye on it just for fun, but it's not going to be in the system anymore. Short-term holder net and long-term holder net, again, still not where I want to see it. I'd rather these be reversed, but it is what it is currently. I think other than that, the market cap change, this has spiked up, which is good to see. Retail is still nowhere to be found. You can see retail investor volume is still under 0, so it's negative. Cohort balance, again, nothing much to glean there. And again, market cap has spiked up, which is good. Smart DCA is no longer signaling, obviously, because of the price performance this week. So with all of that out of the way, that's the on-chain stuff. I think what we'll do next is take a look at the liquidity heat maps, which we did last week for the first time. And I know I mentioned 103K. And what I probably should have said in the beginning is that this is not prescriptive, right? These give you decent price targets in terms of potentially where price wants to go and mean reversion tactics, But just because there is a cluster of liquidations at a certain price does not mean that it has to get cleared. So keep that in mind. And there's a tweet about this that we'll go over in just a little bit that kind of points this out perfectly. So let's take a look at the 2-week to start. And for the 2-week, if it'll load, you can see this has not changed. The 108K level is still super high in terms of liquidations, but obviously we did not touch those and clear them out. We just bounced from this area and just continued to rip higher. If we look at the 1 month, I think it's sort of the same thing now. We've basically cleared out liquidations to both sides, and you can see there's still this 108K area, although it's not super bright. So that's the 1 month, and then we'll take a look at the super long-term one, which is the 3 month. And I think this one has been pretty much completely cleared out. So not a lot of liquidations to really talk about for that. So let's get into the tweets this week. And actually, we will start with what I was just mentioning, which is the liquidation maps and how you have to kind of take them with a grain of salt. I think they're useful to look at in terms of short-term potential pivot points, but don't put all of your eggs in the liquidation heat map basket, because that is not going to be a good long-term solution in terms of finding entry points or exit points, but it could give you a decent map to where price could potentially go. You can see here Pigeon writing that 2020 breakout above 12K, heat maps showed heavy liquidity under 10K, and Bitcoin ran immediately to 40,000. So belief in bearish heat maps keeps short stacking. The squeeze accelerates. Bears are delusional. Bitcoin will leave these untouched for months during the mania phase. So this is a quote tweet to someone who posted, sorry, I can't be bullish with this big liquidation left under the price on the first day of October. And you could obviously see now that that guy was incredibly wrong. Here's the actual picture. This is the same thing that we looked at last week. There was liquidations at 108 and potentially all the way down to 103 that ended up just not getting touched at all. So keep that in mind going forward. And let's continue on. Let's go through the rest of the tweets. Jury and Timber here, amazing account, amazing macro analyst. Definitely suggest a follow. The boom in CapEx spending has been a major feature of the current cycle. And below, we can see that companies are now spending 7% of their ever-growing revenues on CapEx, while spending 10% on dividends and buybacks. This is because these companies need data centers. They're going to need energy for all the AI empowerment that is coming. There is not enough supply in terms of data centers, warehouses, energies. Companies are going to be spending like mad on these things, and there's going to be a huge build out going into next year as we get ever closer to AGI. So keep that in mind. There's definitely some amazing stock plays in terms of buying the picks and shovels for this AI gold rush. But again, I don't really focus on stocks. I think AI will be using crypto. They're not going to be using USD or any other kind of fiat. If you're sort of paying your AI bot or your actual humanoid robot in your house that's doing cleaning, it's most likely going to be in crypto. So still super bullish on Bitcoin and everything else in the ecosystem. Another tweet here from On-Chain Mind. Every Bitcoin cycle top, has lined up with extreme on-chain and macro signals. The score here, which is 17 indicators in one, nailed them all. Always at 100 to 80%. Today it's just 66. So basically the on-chain data is saying we haven't had a blow off top yet. And this chart, you don't need 18 indicators to see something like this. You can literally look at the MVRV ratio Z-score, and it's pretty much in the same area. Even the Puel multiple will give you something like this. So you don't need to make an 18 indicator or 18 input indicator to get something like this. You can get this pretty much from any on-chain indicator like MVRV. So whatever. Anyway, let's keep going here. So I did want to call this out. Again, this is something I mentioned last week. Someone tweeted about the timing. So Benjamin here saying this blueprint is generally following. While August was red and September was green, August marked the local top and September marked the local bottom. Then Bitcoin usually goes up in Q4 into the cycle top. So I think the cycle top for BTC is before the end of the year. Again, this is one of those mid IQ, low IQ, takes where the time has to line up because the time lined up last cycle. This is a different game this cycle. The debt maturity is extended in terms of the debt rollovers. The business cycle hasn't picked up yet. We look at ISM and PMIs basically every week when the data releases. We're still sub 50. I don't think there's going to be a cycle top for 2025. I think that's definitely going to continue. My base case is 2026. End of Q2 is sort of my estimate at the moment. Could that be wrong? Of course, but could we have a local top at the end of the year as people take profits, need to do stuff around taxes? Of course, but saying that that's it and we're going down from there, I just don't agree with it. So it is what it is. It's another one of these timing takes, and I just don't agree with it. So whatever, keep that. We'll keep the receipts for that in a couple of months. Matthew Siegel here. Citi introduces new 12-month price targets for digital assets. There was a bunch of banks tweeting new price targets this week. So the base case for them is 181K for Bitcoin for 12 months from now. So that would put us in October of 2026. And the bull case is 231K. Bear case is 82K. So whatever, price targets from banks. I don't know why people really care about these too much. If banks are giving price targets, they're going to front run retail anyway. So it is what it is. The last tweet here, if I can actually find it. Oh, so this wasn't a tweet, but it was related to this chart. If I can actually zoom in on it so you can see what the hell we're looking at here. So this is the difference between Bitcoin price and volatility adjusted comparison to gold. And you can see Bitcoin price is minus 50% in terms of the vol adjusted comparison to gold. So Bitcoin has been lagging gold. I do have a chart for this. I will show you right now so you can see what I'm looking at. And so here is the chart I was talking about. Bitcoin here is in white with gold in blue, and it is offset by about 9 months, 8 to 9 months, something like that. And you can see that the correlation isn't perfect. There have been gaps before in terms of price, but generally gold leads Bitcoin. And if we do continue this correlation and Bitcoin sort of catches up, you can see even towards this base right here, that would put Bitcoin at 150,000. And with gold at new all-time highs here, that would put Bitcoin at 175 to 180,000. So definitely keeping an eye on this chart and keeping an eye on gold performance, as they are both debasement hedges for fiat currency. So that's pretty much it for this week. I hope this added even a little bit of alpha to your life. I spend a ton of time doing the research for these every week, so I really hope you enjoyed. If you did make it this far with me, thank you so much for sticking around and watching till the end. I really appreciate it. If you did like the video, you know what to do. I'm not even going to ask you for it. And as always, have a great weekend. I'll see you next week for the next Bitcoin Macro War Room. Cheers.